Welcome, folks. I have been waiting for a little bit until more people join. So let's wait probably 1 more minute before starting. And of course, as usual, you can hear me. Just type on the chat window that the sound is fine. Thank you. Okay, welcome to the live stream, the live video of the Gamma Optimizer room. Welcome again, folks. So let's try to do this quick so I can show the new tool, the Gamma Central tool that I've been trying to complete. So let's go over the positions. So right now, because I've been bailing out in GDX, I don't have GDX anymore on the list, if you can tell. It's gone forever and ever. Well, at least it's gone from my official tracking. I still have the positions. I mean, I just robbed them off. So I am assuming a total loss right now. But in the unlikely event that GDX actually goes to the moon, then I'll profit, but I won't be able to brag about it here anymore. So no more GDX for me. I guess it was an interesting trade, but it didn't work well. So let's move into XPX. Our main trade on XPX is the risk reversal right now, or at least for me is the risk reversal, which is actually making money. It's actually making 10 cents. I cannot believe it. The risk reversal was open on June 12th, so almost a whole month ago, and the market didn't move up. In fact, we are a little bit below where the market was when we opened the trade. If let's check here, let's look where the market was when we opened this trade. In June 12th, when we opened the trade, we were around here in this area. So the market was around the same, basically the same value it is right now. It has been an interesting trip. It has been an adventure, yet the risk reversal has always been there in the range. We were shooting for the moon. I guess we were shooting for 2,485. So we are still 62 points from it, and it's only one more week to go for the 62 points to materialize. But the good thing about the risk reversal is that, as you can see, and let me show you the details. The good thing about the risk reversal is that, okay, even if the move didn't happen, but the market stayed between 2,400 and 2,485, we'll claim the credit. And the credit that I got for this trade was really good. I got 72 cents credit for it, so it's a substantial amount of money for my position, so I don't mind that for a month of work. The thing is not doing much, and it only came under attack last week, and we have a very cheap hedge for it. We have a very cheap hedge also, just in case something unravels next week. But this trade is performing really well. Look at the hedge. This is the hedge for the trade. I cannot believe the hedge is actually break even right now. This is also very surprising. The hedge only has a few more days to live, yet it is green in the sense that it's break even. So I don't know. I guess that's the market for you, where both the position and the hedge make money. And then I have, okay, now it's just that they are just barely breaking even. Now we have the next big trade, which is the short gamma trade for the what I call the summer trade. This is a calendar trade. If you can see it here, is centered around 2,450 and is for the end of July. So we still have plenty of time for this trade to go. We probably have like 20 something days to go, and 20 days to go on this one, calendar days. So it's not bad. We still have plenty of time, and it is a slow cooking type of trade. Right now it's losing 30 cents, which is not much compared with the cost of the trade. But the trade will start as July progresses. That trade should start providing really good money. I mean, it should go into 3.5s, 4s pretty soon. So that's another trade that I'm happy with. I'm not even hedging it at all because we are right there in the range for the trade to pay. I have an unofficial vertical lotto, so I won't talk about it, only to say that this is unofficial. I just did it for fun, and I guess I lost all the money. But the market did move up, you know, for my credit, to my credit, the market did move up quite a lot. It's just not enough for what I needed. And then we can move to the whole XLE complex. So this trade was really on the green on Monday, and it's very interesting because I was advising everyone to manage profits. We were profiting more than 100%, and I guess I was the only one from you guys that didn't manage my trade. All of you managed the trade. I spent Monday doing all sorts of things, but I kind of forgot about the XLE. I was like, I'm not even concerned. But so right now, the whole trade is in red because well-known events that have happened. XLE has basically collapsed. It's tremendous volatility. So I think I'm going to scrap the whole trade. I just spent like $500 on this, so I'm going to scrap it. But I don't know. I don't know if I should just scrap it or leave it there because it's until July 21st. I think I might leave it there just for fun. And see if I can get another 100% return on that one. But this thing is this underlying has tremendous volatility, and I mean the profit on the 2.5x profit became a loss really quickly. So it's a lesson when we are trading on very volatile underlyings, just to take profits early and follow your own advice. I mean, I keep advising everyone to monetize profits, but I didn't. So it's okay. So that's the state of the current open positions. I was planning also on shorting volatility yesterday, but I mean, yesterday the world didn't end. So volatility actually didn't move. And I guess the volatility market didn't believe at all what was going on the SPX market, because even though volatility went up, I keep posting yesterday about the term structure, and the term structure of volatility was really normal. It was just the same contango structure, it's just a little higher. It's very different to what we got last week. Last week we actually got a flat term structure. That's the one I love. When you get flat term structures, means that the world is ending. So when the world is ending from the point of view of volatility dealers, then you could also do all sorts of interesting trades. In particular, shorting volatility is a very good trade. So anyway, so no volatility shorts for us this week. It was a short week, but very moved also, but short, so there was no time for many trades this week. In terms of, let's see, let's look at quickly things in terms of momentum. So let's look here, and I always have to come here. So I don't know if you have used, I'm going to show you this. If you go to the Gamma Optimizer web page, you can actually see a few mini apps too here at the bottom. So you can, this is the easiest way for me to remember where all my little apps are. So I have the Momentum Center here. So let's look at the Momentum Center and see what the market is doing. In terms of momentum, the momentum is turning positive. Yesterday we got an outlier day. If you notice this cyan dot here at the bottom, in terms of momentum, it was completely out of character for all of them. But the reason is because of the way the M5 trend is computed. It was comparing the return with the return from the previous 5 sessions. And if you remember, we got a very high up day, which is this cyan dot here, last week. So we were comparing a down day versus a tremendously high day, and so the return for the weekly return was tremendously negative. But today we are kind of back to more or less the area once we remove the outlier that happened last week. So we are back here, and you can see the momentum on the market is actually turning. This is positive and encouraging for those of you that are bullish the market. I know that that's not the consensus view. I know a bunch of our experts in the EWT room are looking down, but at least I feel that I'm in good company. I know that Xenia is looking up. At least she was looking up until today. So we'll see. We get more downside, but I'm expecting a little bit more upside base and a bunch of stuff that I'm seeing that I'm not showing here. But at least the momentum chart is kind of giving us a little hint of what is going on with XPX. For those of you in the metals, really there is no hope. I don't know. I mean, I guess this is capitulation. The momentum, the trend is tremendously negative. It has been negative since June 26. It's pretty much around that area where the Fed meeting happened, and then we just keep moving down and down and down. Gold doesn't look that much good either. But I mean, if your horizon is really long term, you could do interesting things with there. I mean, bullish bets, if your horizon is really far away, you can get them really cheap because no one is really pricing upside for this. So let's look at silver. Yeah, silver is even worse. My God, like silver is really basically, I don't know, I guess if you are one of those people that are really positive, you could claim that it's so bad that it should start turning soon. I mean, there is no more room for negative momentum. I don't know how much negative this thing can go. So that's where we have in terms of trends on the main markets that we follow. Let's follow XLE just for fun, and so I can cry with my positions. Let's see, with the XLE. Well, I mean, momentum turned negative, but it's not that much right now, but it is negative. So bullish hopes for XLE will take a little while to materialize. So that's in terms of these things that I'm tracking here. Okay, so now if you have any questions, I always my disclaimer, you can type questions anytime you want. But if you don't have any questions, let's move to the new Gamma Central application. You can find the Gamma Central here on the Gamma Optimizer. This is only available to subscribers, so you have to be a subscriber. The other two tools are available to anyone. You can just copy and paste the link, but for the Gamma Central, it doesn't work like that. It is only available to subscribers. So if you're a subscriber, you click on that, and you come to the Gamma Central. And the Gamma Central is a very simple interface. It kind of prods you to do something. So let's do something here. Let's click go. And it shows 3 pieces of information. It shows the BRP table for the underlying. It shows the term structure and the volatility con. If you are an options expert, these things are, right now you know what these things are, no? But if you are just a beginner here, even though you don't know what they are very useful. Those things can be very, very useful. So for the VRP table, remember, you can watch the video about this on my YouTube channel, but the VRP table is something that is really useful when we want to see if options are overpriced versus recent realized volatility. So it's just basically a comparison between the implied volatility versus the realized volatility for a comparable period, and the VRP is just the percentage. It's a percentage of overpricing or underpricing. So in this case, this is overpricing, and the red things, negative values, are underpricing. You could use this to, pick if you don't want to use the optimizer, the Gamma Optimizer, you just quickly want to look for options by hand, you could use the BRP table to pick cheap options, and cheap options are options that have lower values of BRP. So not necessarily lower values of VIX. This is an interesting thing. Now, very interesting that, for instance, let's see, something that is expensive but it has a lower. For instance, look at this. This one has 35% implied volatility, which is substantially higher than all of the previous ones. However, in terms of BRP, is only 7.8%, only 8%. The variance risk premium for this line. So this line for January 19 is actually decently priced in GDX, and you can run this for different underlyings, for all the underlyings that you want. So the BRP table is helpful to identify cheap options if you want to buy them, and it's also very useful to identify expensive options if you want to sell them. So if I come here to this column and look at the VRP, the highest VRP is for July 28. So the options for July 28 are, even though the implied volatility seems decent, they are terribly overpriced compared with recent realized volatility. So what that means is, if you are doing short gamma positions, if you are a net seller of options in this expiration, that means that you're getting a good money for the risk, because you are selling an expensive VRP. So the VRP table can be used for a couple of things. I could Someday I'm going to do a full class, but remember, in my YouTube channel there is a more in-depth explanation. Then let's move to the trend structure. This is something that I always post, mostly for XPX, but you can see the trend structure for any underlying. Trend structure shows you the implied volatility of different expirations. So the x-axis is just the days to expiration, how many days, 100 days, 200 days, 300 days. No, this section is the near term, and it shows you in the y-axis the volatility as measured as the same way the VIX is measured. No, is implied volatility with the same methodology. So what is good? What is the time structure good for? You can see the expectations of future implied volatility for the underlying. So in an orderly market, you will expect this kind of slope. You expect low volatility near term, getting higher and higher the farther you go. And GDX seems to be really interesting. GDX seems to have a complex dynamics here, because volatility is moving down the farther you go. So probably this point here at 196 days is an important date. So this point is basically January 1st. I guess the turn of the year is very important for GX, so I guess people are overpricing for that, and then for further out is kind of underpriced. But something interesting here is what happens near term. Near term, you can see some spikes here. You can see at 14 days there is an spike. So that means that option dealers are kind of expecting volatility in GDX in the near term. So in the next 2 weeks, there seems to be very volatile. They're expecting moves. Of course, you don't know if the move is up or down, but it seems that's how it is. No, that's how it is. So the term structure is very helpful to figure out things like that. Let's look at something that has a crazy term structure, so you can see. For instance, Tesla. Tesla should be like the craziest term structure of all. So that will be easier to see. Look at Tesla. This it doesn't get more crazy than this. Tesla, it is basically flat. It's a flat term structure, with the exception of this data point, which I think is wrong. I think this is August 34.6. This is August 25th. I think this option line, and I noticed this for Tesla and Amazon. I have noticed that for some reason the volatility for this option line is not the same volatility than the rest. So I think this is an incomplete expiration. But so let's ignore this point. If we ignore this point, you will see that it's mostly flat, and then we see tremendous spike in this area for Tesla. So what is the term structure telling us? That people are crazy, like they are really overpricing all of the options right now. They are tremendously overpriced, and we can see that probably there are earnings around this point. So probably the earnings date for Tesla is not set in stone yet, but it could be it could be August 4th, the week of August 4th. That's where the craziness starts. But even without the craziness of earnings releases, Tesla has been really active in the near term. If you look at the VRP table for Tesla, you can see that it's negative here in the near term, but it's negative because Tesla has moved a lot the past couple of days. So this tremendous movement was not priced in the options, and the options are not anticipating more of the same. So that's why you have this kind of negative VRP. So Tesla is a crazy underlying, but that's the whole point of the term structure. And the fact that even the room, because I saw this so flat, this is so tempting to do things like, what happens if you sell volatility in this area and you buy volatility in this area? You know what will happen after earnings? What will happen after earnings is that the curve will revert to normal. It's over sloping. So this volatility here will collapse, and this one will kind of remain in this area. So you can pocket the difference between the two. It is a very interesting type of trade where you don't have to guess the direction of the move. You just only betting that there is going to be a collapse and the near-term volatility versus farther out volatility. So something that we'll design eventually. So that's the time structure chart, and right there it gives you lots of information, lots of interesting information, and it works for any underlying that you have in your mind. And finally, let's take a look at the volatility cone. Volatility cone is a very professional type of chart. Not many retail software provides it. You need to have kind of specialized tools, but it's a very useful tool. In particular, if you are dealing long term and if you want to see how the volatility looks compared with historical volatility. So in this case, the volatility cone is using 7 years of real data. I like my cones to have 7 years because 7 years you have all sorts of things. During 7 years you have crashes, you have, I don't know, you name it. So in the case for Tesla, well, and of course I'm not even sure if Tesla has been around 7 years, but that's what the volatility cone will try to compute something in that period. What does it mean? How to read the volatility cone? Well, first, it does look like a cone. You notice it kind of looks like a cone. But what it is, okay. So the volatility cone is a chart that charts volatility. So this is volatility, but in the x-axis is the time. So this is basically, it's telling you, for instance, let's look at these last points. It's telling you that 360 days for the last 7 years, we have seen a max volatility of 59% and a mean volatility of 33.5 and a mean volatility of 49%. So it's telling you kind of the information on how in that long range of time volatility has behaved. How is that useful? That is useful because if you are trading with the same time horizon, if you are trading with 1 year out, so you kind of can expect realized volatility to be in this range. So you can expect realized volatility to be bounded by 33.5 to the low side and 59 to the high side, and an average of 49.65. So that allows you to plan for this. If you know what is the kind of the volatility in that period, you can plan for your trade. You notice as you get closer and closer to today's date, the cone starts to get crazier and crazier, because in the shorter terms, let's say in the first 50 trading days, the volatility can be really crazy. For instance, for 7 days, we have seen historically we have seen volatility of 210%. Max, and we have seen volatility of 7.9 in the past, and I have seen a mean volatility of 43%. So you can tell, if you're trading for the near term, you are exposing yourself to big swings in volatility, and that's what we have seen in this underlying. In particular, Tesla, which is a crazy stock, will exhibit something like this. But more importantly here from this chart is the red line. The red line is kind of the historical mean, and it gives you a good idea of where we are. This is the historical mean, and then we see the options. The black line in this case is the volatility of the options for Tesla, and you can see that the options are priced almost on top of the red line. And notice that this is the only underlying here, which is the same point here, exactly 49 days. So let's ignore it. But you notice how option dealers are basically pricing the options for Tesla on the red line. What that means is they think the Tesla will follow this script. And it's not a coincidence, because option dealers use very advanced software to price the options, and the software is telling them the same. I mean, in Tesla, it's such a beast that it's better to price the options here. So let's say that in this case, options are fairly priced based on 7-year historical volatility. That's how I can say it. Let's compare this with something else. Let's compare something with GDX. Let's recompute GDX here, which is a normal. GDX has a different cone, and it has, as you can see, GDX has different profile. No, it doesn't open up that much near term. It's still crazy volatility of 100%. But notice that the red line is higher than the options line, which this means is that options are actually underpriced in GDX. So option dealers for GDX are actually pricing the options cheaper than the historical mean. So why will they do that? Why will they not charge you more money? Well, it's because they charge as much as they can get away with, and they cannot get away with the mean. So what that means? That means that the view of the market for GDX is that the volatility in the next year is going to be lower than the historical volatility for the past 7 years. So it gives you a good idea about how option dealers are seeing the future of the underlying. And also it gives you a good idea of if you are buying into expensive options or cheap options. This is one of the best tools ever that you can use to figure out if the options are expensive or not. VRP tables are very useful to see if options are expensive or cheap versus very near-term realized volatility. I mean, the table is only comparing the implied volatility with equivalent realized volatility. So it's only like 1 year or 2 year stops. Like look, 2019 January is like 1.5 years. So this is kind of is looking at a very recent history, while the volatility cone is looking at really far away history. So together, these three tools can give you tons of information, a lot of information about a particular underlying, and also it can give you really good information about the options. So in the case of GDX, we don't see anything. We only can tell that the option seems to be underpriced compared to the mean, and also they are kind of flattish. No, so we don't see anything strange. But let's look at something like SPX. SPX has a richer set of charts. So let's look at XPX. XPX will tell us very interesting things. So when we look at the volatility curve of XPX, now we can see things that are very interesting. We can see that the option, the black line for options, it actually crosses over the historical mean around here, which is like 120 days. So 4 months ahead, option dealers are starting to overprice the options versus the historical mean. And in the near term, you can see the opposite. You can see that options are underpriced on the near term. So options start to be underpriced on up to 60 days. So this is a very complex and interesting cone because it gives you an idea of the mindset of volatility of option dealers for SPX. They are anticipating higher volatility than historical in 4 months. So probably that coincides with September. And I think they are really good at this. I mean, September historically is usually very volatile, but they are anticipating that this September will be way more volatile than the past, the Septembers from the 7 years. And also near-term volatility remains tremendously depressed. So these things completely blows away any extremely bearish thesis. I mean, the market could keep going down, but it's very obvious that the volatility market, the option market, is not pricing any major event in the near term, and the proof is on everything that you see here. Look at the VRP table, is full of negative signs and low VRP, so that means that options are not pricing in more downside or massive downside. And look at the term structure. The term structure looks like perfect. It's like extremely low volatility in the near term, and then grows nicely, and then kind of tapers off. Last week, this thing was almost inverted and flat. So this is a picture of, what will I call this? I will call this as a picture of complacency. The market is not expecting anything. There is no nuclear war with North Korea. There is no conflict with Russia in Syria. There is no threats to global markets. The option market is very practical. That's what it is. I mean, those are where the options are priced, and it's telling you that the option dealers are not overpricing for anything, at least on the near term. So hopefully this Gamma Central tool is something that you will find useful. I am adding more things. This is just the first page. The Gamma Central tool will have many more things, but this is more than enough for you to start and play with it. I will be adding the open interest and put call ratios soon. And finally, I'll do a video about this. I'm going to do a full video about this thing. But about how to use it, but this is what I have right now. So hopefully you enjoyed. And again, if you want to use it, the easiest thing is to come to the Gamma Optimizer and click on the link at the bottom. That's the easiest way to execute the Gamma Central. And with that, I open the thing for questions. Let me know if you have some questions. Otherwise, I can basically stop the broadcast here. Just go ahead, guys, participate. Ask anything, even if it's not related to anything that I said. If you have doubts about a particular trade, or if you have ideas. Okay, so far there are no questions. So I'll leave the live video for today. Please play with the Gamma Central tool. Give me feedback, give me ideas. I am adding to it. It will keep growing. And also in the pipeline, I have another tool that is coming up. I planned to have last week, but the Gamma Central was taking a lot of my time. The short Gamma Optimizer is coming, guys. So you will be able to finally design the trades that are use complex options and use butterflies, calendars, risk reversals, back ratios, all sort of weird things. So it is coming. We'll see if I have impeccable timing and I release the short Gamma Optimizer just when the market moves into a long Gamma regime again. So anyway, guys, thank you very much. I hope you have okay. What is interesting about Tesla ball structure? Okay, so Tesla, the thing, look at the term structure of SPX. This is how the term structure for pretty much everything should look like. Near-term volatility should be low because there are no expectations of anything major happening. And then as you go far away in time, the volatility gets higher and higher because there is more uncertainty of what is going to happen in the future. So this is a normal upward sloping term structure, and this is what is called contango. Contango is that it's growing and growing and growing. For Tesla, notice this in Tesla. Tesla doesn't follow that. Term structure in Tesla is nothing like that. Term structure in Tesla, if you ignore this data point, which for some reason I think is wrong, is flat, completely flat. And flat in, if you have followed my post in the room, flat means end of the world. People are waiting for the end of the world in Tesla. And not only flat, but it's inverted. Near-term volatility is substantially higher than far. But there are reasons for the inversion. The reason for this inversion is earnings. The earnings release around this date. But however, the near-term volatility is too high compared with the longer-term volatility. This is too high, and you could design trades to exploit that. That's what is weird. Okay. If there are no more questions, have a great weekend, people, guys. Enjoy. Let me know your questions in the room. I'll keep updating the Gamma Central tool, and we'll see if the market next week can go to the moon or stay in this area so we can profit from our risk reversal and extract max profit. Take care, guys. Bye-bye.